Hi guys, mic working? Great. Okay, so hopefully you'll find this very interesting. So we are CausaLens, pioneers of a new approach to machine intelligence. And I think we've heard a lot through the presentations this morning, both in RegTech and in here, about the challenges of really getting machine learning and AI to work in financial services. Challenges of fairness, bias, trust, explainability, openness of models. And fundamentally, we believe, and many of the AI pioneers now are moving in this direction, that this is a problem with the way machine learning has kind of developed historically. All machine learning algorithms and AI approaches that are out there in the world today are correlation-based. They look at the data and they try and map patterns and features to something you're interested in. But that, of course, is not how we think, and it's not how we solve problems. And we think it's time for a new approach and machines that can reason in the same way humans do, and to bridge that gap between humans and AI. If you've read Daniel Kahneman's book, Thinking Fast and Slow, fantastic book about the way the brain works. And there's kind of two modes of operation. There's the automated response, which is a bit like our black box machine learning. So we have neural networks, obviously that's where they came from, in our brain, that recognize cats and dogs and people's faces. And that's completely automated, and we don't think about it. And it works because the data generation process for those things does not change over time. A cat has looked the same for the last several million years. But none of the problems we solve in real life are anything like that. So if you take the really simple example of just getting interrupted by your dog while you're doing a meeting and making a decision about what you're going to do, that is not a static process. That requires a model of your boss, your meeting, how important it is, your dog, when you last fed them, how hungry they are, and the dog's personality. And then you make a decision. You actually think through what you're going to do. You weigh up all the pros and cons, the risks and benefits, and you make a decision. And that is how humans think. And until we bridge that gap to get machines to present information and models in the same way, we will have this problem of machines and humans communicating with each other. And that is what we're all about at CausaLens. So what I'm going to talk to you today about some of the challenges that we have at the moment, and they really do exist, these challenges with current machine learning process. The regulation that's coming in from the EU, from the US, from the Singapore government as a forcing function and actually driving a better way forward, and an introduction to this new brand of machine intelligence that we call Causal AI, which we believe bridges a gap and solves a lot of these problems. So let's start with the kind of regulatory angle. This is not a sort of trivial problem. We know, if you've watched The Social Dilemma on Netflix, the way algorithms can actually affect people's lives in a negative way is actually a real problem. And potentially what the regulations are opening is almost a Pandora's box. It's not just machine learning algorithms, it's all decision systems that we are using in financial services, whether it's credit risk or other ways of interacting with customers, could be biased. They could be unfair. And actually, we have to start unpacking that and working out, is my lending model racist or is it, gender biased? And current machine learning methods are struggling with those sorts of things. Explainability is key. The new EU regulations have teeth, and really to properly meet those regulations, you must have completely explainable models, what we call sort of 6D explainability through every single angle. And there's some other fundamental problems. The cartoon on the left about the spurious correlations. There, you probably can't quite see it, but you've got shaved heads and sales correlated with each other, and then the conclusion is, everyone take a razor. Now, it's a silly example of the shaved head as well, but the problem is, in real machine learning projects, in the bank, every year or month, these things happen. You get these silly recommendations. They go all the way through the process, they get to the business, and the business says, this makes absolutely no sense. Go back and start again. Classic examples are, my customers churn because they've had a lot of sales calls from the relationship manager. There's a massive correlation, but they've completely missed the causation, which was the relationship manager was worried they were going to churn and started doing more sales calls. But the machine doesn't know. The machine has got no idea what any of these things mean. And that's the problem. There's no cause and effect. There's no mapping, there's no understanding, there's no logic applied. So that needs fixing. And And we see that all of these sort of challenges in the environment, whether it's the regulations, whether it's trust, whether it's regime shift, they all lead to a fundamental principle, which is trust. If we're really going to adopt and embrace AI and machine learning in financial services and in the rest of the economy, not only have the business experts and the users got to really trust and believe in these models, so have our end customers. And they've got to be transparent. The regulations are forcing that. It won't be long before customers are ringing up and saying, okay, prove to me why I didn't get a loan. What would I have had to have done differently? And if you don't have a good answer to that, there's going to be a problem. And there is a path forward here. And we think, given the sort of the way the regulations are moving and the world is waking up to this problem, that this new way of getting machines to present the way they're processing information in a way that humans naturally can relate with is the path forward. And we can imagine a much brighter future for the collaboration between humans and machines. So, gentle introduction to what causal models are and why they're subtly but very fundamentally different to the way standard machine learning works. So this is what we call a causal diagram. Very, very simple one. Only 3 pieces of information here. But this is quite relevant because last year, when the vaccination program ramped out, this is exactly what happened. Now, when Israel was one of the first to get their vaccine program out there, they got 80%, 90% of the people vaccinated. And then somebody noticed a correlation that most of the people in hospital in Israel had been vaccinated. And it made the news. And anti-vaxxers jump on that and stuff. That's a correlation. And your machine learning models will have things like that in it. It's what we call a spurious correlation. The problem is there is a confounding factor, which is the age of the individual. Now, we know that the vaccines were rolled out in age order. So you were more likely to have the older you were, the more likely you were to have the vaccine. And we know age also affects the severity of COVID-19. If you draw this diagram and resolve it correctly, you get the right answer, that the vaccine reduces the severity of the disease. If you don't draw this diagram correctly, you get the wrong answer. You can actually get the answer in the wrong direction. This problem even happens in the simplest machine learning models. A logistic regression model can have this problem. It's called Simpson's paradox, and it exists. You get the wrong direction. You can get to the end of a review process with the business, and you have some economic factor, and you say, this factor decreases the risk to the bank. And the business expert says, no, it doesn't. It increases the risk to the bank. And it's because you've got correlations between the inputs and outputs, which are confounding the model and making it do nonsensical things. You have to go back to the beginning, and you have to rebuild your model. There's a better way. So what we envisage, this is a more like realistic causal diagram. So this is a simple example from sort of churn and marketing. But the idea is to bring the human and the machine together, you must let humans interact with the cause and effect model. You have to have a hypothesis about the way the world works. And you have to impose some of your ideas to get the model to work correctly. Can be counterintuitive to data scientists, but it's absolutely proven and true. You cannot generate the correct model of the world just from the data. Classic example of this, if you take Newton when he discovered gravity. You take the raw data for where all the planets are moving around, you run them through a machine learning model, you'll never discover gravity. You have to have a theory. You have to have an idea about how the world works, that maybe the planets, communicate with each other and there might be this force. Once you have that idea, the model comes out and it's perfectly accurate. And that's kind of the principle we're doing here. You're getting your business experts to understand their model of the world and join that with the machine learning models and join the two in together. So you can do bottom-up causal discovery from raw data, discover a causal graph, and you can do top-down constraints and say, I think this economic factor affects my customers in this way, or my competitor pricing is going to affect my customers in this way. And humans know what direction those relationships have. Your model will come up with a much better answer if you help it with that initial piece of information. And, even better, the business experts who receive your model in the end will already be happy with it because it represents the model of the world that they already believe in. These causal diagrams are very much the way we think. Something affects something else, which affects something else, and then I make a decision, and I can balance all the different competing priorities. So, real example. So this is a causal diagram for loans. The other great thing about this approach is because you've basically learned how all the factors affect each other, not just how they affect the target. That's key. So if you're trying to do things like bias and fairness analysis, you're trying to understand whether gender affects whether you make a loan or not. You may not want gender in your model. You don't want gender in your model. But you need to understand how gender affects the other things that are in your model. You can do that very naturally in a causal diagram. So in this example, we've got gender, we've got age. They sit on the outside of the causal diagram, and they affect things like income and things like, time with the bank. We can then test exactly how sensitive this model is to those, and we can change the model, and we can retrain the model with sensitivity characteristics. So you can actually say, I don't want this model to be more than 5% sensitive to gender or race or any of those other characteristics. You can actually prove it and test it. And that's key to sort of the next stage of machine learning, not only in financial services, but in many other industries. You can also, these models are more robust. They're effectively, you can start with these relationships being linear, but you can make them non-linear as well. You can learn whatever types of relationships you want. But they're a full simulation of the world. They're not a kind of static mapping of features to a target. They're a full simulation of the world. So you can do what-if and scenario analysis. You can understand what the future might be. So in your credit model, some of the inputs might be the inflation rate, the unemployment rate. You can actually test exactly how the model will respond in a future that you imagine. So if inflation goes up or employment rate changes, this model already has a map of how that will affect your whole portfolio and each individual customer in the future. Fraud is another great example. So fraud, the amount of fraud across financial services, payments, banking, just keeps going up, even though we keep investing in the technology. Partly that's because the attack surface keeps going up. So obviously, with more and more online banking and payments, you are going to get more fraud. But there is also another fundamental problem, which is the speed at which fraud changes. It's a classic example of a data generation process which is definitely not static. Whatever you put in your defenses, the fraudsters will immediately try and learn that and counteract your defenses. So any model, rules, machine learning that looks back in time will immediately be defeated by fraudsters once they learn what you're doing. And the problem is that the banks and the processes can only respond to that very, very slowly, like months or potentially even years. With these dynamic models, you can actually disentangle what's actually driving this. You can actually understand what the fraudsters could change in their attack tactic. So they might be targeting payments at a certain amount or people of a certain age or something like that. But a lot of those things, they have an opportunity to change. You need to make sure, and you can see how sensitive your model is to those, and you could actually adjust those. You could remove those sensitivities, and you could make a more robust model. You can also understand, if we take like APP scams, which is the sort of social engineering fraud, which is a massive problem at the moment, it's a very tricky challenge for banks because it's really hard to intervene. It's the customer who's initiating the transaction. So this really becomes an education challenge, or how do you mitigate it before it even happens? It's a complex model of the beneficiary, the person who's making the payment, their payment journey. But if you can disentangle these effects, you can actually understand exactly how scam propensity and age are related to each other. So in this example at the bottom, you've got young people who are more likely to fall for a scam because they're kind of new into financial services. Then kind of the middle group are much less likely, and then it sort of goes up again with age. You can understand this intuitively, and it kind of makes sense. You can actually go, okay, that's a pattern that I understand, and it makes sense to me. Same with time since they last read an awareness message on their app. And the longer that time is, if they've never read it, the more likely they are to be scammed. They've never actually educated themselves. Once you have those relationships, you can sort of dynamically test the response. So what would happen if we got everyone to read the message within the last month? What would happen to our scam volumes? Is that an intervention we could do? Should we do it? What's the value of it? And it turns out if you can get 90% of your customer base to have read the message in the last month, you can halve your scam propensity. So that gives you a business case for an education campaign or make it more prominent in the app. Or you could come up with a new strategy for intervening in payments based on amount and the amount they've got in the account and their age, and a tailored message to help break them out of that scam. And then sort of the final example I've got here is stress testing, related to the sort of regulatory stress testing, liquidity management, forecasting. With these models, you can naturally model the external environment. So the economy is effectively a whole load of complex, dynamic, interacting time series with cause and effect drivers in them. And then you've got the internal environment of the bank, which could be your credit risk profiles, your liquidity, your assets and your liabilities. And they all interact with that external environment. You now have a totally dynamic stress testing environment. So you can put in any potential future scenario on any of those external godlike variables like inflation or energy prices, all the crazy stuff that's happening in the world at the moment, and understand how your internal system and your internal environment is going to respond to that, and build yourself very robust stress testing models. Nearly all these models in the bank at the moment, as been discussed many times this morning, are kind of linear models because they kind of work, they're explainable, and no one really dare do anything else. These causal models can start as basically linear models. But once you have your linear baseline, you can test if some of these relationships you think might be nonlinear. So the real world is actually nonlinear. The economy is very nonlinear. Things don't really just respond in a linear way. And you can, if you want to have a more accurate stress testing model that actually learns nonlinearities, you can decide, and you can let your domain experts kind of guide the model in this way. I'm going to allow some of these relationships to be nonlinear and see what the data tells me and see if I can learn nonlinear relationships. And then you can gradually go from a linear model that everyone's happy with to a more accurate but still deeply explainable nonlinear model. So to sort of summarize, obviously we're one of the pioneers of this, but we're certainly not alone. And the whole kind of AI community is now moving in this direction. So you've got Joshua Benigo, one of the kind of main pioneers of the whole sort of deep learning movement, is now moving his research teams and changing his direction. And he's saying causality is extremely important for the next steps in machine learning. You've got Turing Award winner Julia Pearl, to build truly intelligent machines, teach them cause and effect. And Gary Marcus, another extremely prominent AI researcher, saying this really is the biggest neglected challenge in machine learning and AI we have today. So we really think this is the way forward. And we think that the combination of this kind of new way of doing models, but also the visualization of a system of the world combining the way humans think with the way machines can process the underlying data and bringing those together is really the key to kind of the adoption of AI, not just in financial services, but in many, many different industries for the sorts of decision problems that really have the high value. So away from automation, facial recognition and those things, to actually high value optimization problems, this is paving the way forward. So thank you very much for listening. I hope you found that enjoyable. And I guess we've got time for some questions.